The Reserve Bank's recently cut its interest rates to all-time record lows of 1%. But I know that the first thing that you think of wouldn't typically be, how's this going to affect my insurance? In this video, I'm going to share with you 3 key principles on how these interest rate cuts can further lead to you saving more money when it comes to your insurances. Now, whether your bank has passed on the full interest rate cut or not, this video isn't about this. What this video is about is how you can use those interest rate cuts to get ahead. I'm going to show you in particular how these interest rate cuts can help you get ahead with your insurance and therefore reduce the amount of money that you're spending on this insurance cover as you have this going in the future. As we all know with insurance, that the price typically only goes one way. This video is going to give you a few helpful tips to show you how you can take the power back and use the interest rate cuts to help reduce your insurance costs going forward. To highlight this point, there are 3 key principles that I'd like to share with you today to help explain this a little bit further. Principle number 1. Now, principle number 1 looks at using the interest rate cut for good. Now, a friend of mine, Chris Bates, shared an interesting article on LinkedIn this week that highlighted the interest rate cuts and the impact that this had on the life of your mortgage. The average saving on a $500,000 mortgage is about $70 a month, and therefore the average on a $1 million mortgage is about $140 a month. And what Chris did really well was he mentioned the point of using this interest rate cut for good. What he meant by this was using the extra money that we were saving in interest to continue to make the same repayments to our loan. And what he highlighted in this graph was that by maintaining your mortgage repayment at your pre-cut rate, you'd actually speed up the rate at which you repaid your mortgage and save yourself about 1.5 years off the term of your mortgage and a lot of interest in the same process. Now, this concept of using the interest rate cut for good is a really important one. Now, to put this into everyday terms, I don't know if you're like me, but if I go to the ATM, it doesn't matter if I take out $50, $100 or $200, within a couple of days, all of the money that I've taken out has gone. So I know myself and what I need to do to make sure that I can keep track of my money. And for me, using my card is a much better way of doing it. And I can control the way that I spend my money a lot better and therefore use my money for good. The reason I'm telling you this is that it's the same sort of concept as using this interest rate cut for good. We could all go out and blow this money and put the extra $140 a month into the pot, but it would all get gobbled up in everyday living, spending it on ourselves, and we wouldn't see any benefit of these interest rate cuts. By maintaining our mortgage repayments at the same level that they were before the interest rate cut, we can use this rate cut for good and actually get ahead as a result of the Reserve Bank cutting these interest rates. Now, the government's idea behind these interest rate cuts are to stimulate the economy, so they understand that as humans, we like to go out and consume when we get this rate cuts to then generate the economy itself. So the real trick here is to go against what everybody else does and what our human nature says to do, to spend that money and use that interest rate cut for good. Now, I know I've spoken a lot about mortgages and that sort of thing, and that's not my area of expertise, but what I'm going to share with you now is the second principle that shows you how this relates to how much insurance you need. Principle number 2 is have purpose-linked insurance cover. Now, when I'm speaking to you for the first time, a lot of you ask me how much insurance you think you should have. And for many people, when you've done this the first place, you've picked a number based on how much your mortgage was or some other arbitrary number that you've picked out of the air. The Barefoot Investor has a way of calculating this as a multiple of your salary to work out how much insurance you need. But for me, I believe in having purpose-linked cover based on 4 key criteria. Now, for me, when I'm talking about this calculation in this example, I'm looking at your lump sum insurance benefits. So your life insurance, TPD, and those sorts of covers. These are the ones that you'll typically hold through your superannuation fund. So let's have a look at the 4 things that I think you should be looking to protect to give you some purpose-linked cover for these lump sum insurances. The first thing I believe you need to look at is making sure that in the event of something happening to you or your partner, that you have a debt-free family home. So this is clearing the mortgage should anything happen to you permanently. The second thing that I believe you need to focus on is providing a replacement income for the person who survives. So the surviving spouse to become full-time super mum or super dad, so they can be the best parent they can be without having to worry about rushing back to work. This is the section that I see the biggest variables come in based on your personal needs. There might be some people that can live off a lower amount of money every week, and there's other people that will need more money as an expense even on top of their mortgage, depending on what their lifestyles sales look like. The other big variable factor here is how long that income's actually paid for. I believe that with the right conversations and questions around this, you can come up with an appropriate story around how much income you need and how long that needs to be replaced based on your individual needs. The third thing you need to consider when you're looking at having a purpose-linked insurance package is what liquid assets you have available to you. These available liquid assets include things like superannuation balances and net assets from investment properties, cash, those sorts of things that you might have as well. By working out what your liquid assets are, you can then take this off how much cover you need to give yourself the minimum amount of insurance at all times. The final thing you need to consider when it comes to having purpose-linked cover, I believe, is having some money for funeral and final expenses. By considering these 4 things when you're looking at a personalised insurance package, not only will you have an amount of insurance that's personalised to you, but you'll have a really good framework for coming back and revisiting how much insurance you need as your needs change over time. That brings me to principle number 3, scheduling in periodic reviews to come back and revisit how much insurance you need. Much like my point about using the interest rate cuts for good, having any more insurance than the minimum amount for you means that you're wasting money on insurance premiums that you don't need. By following principle number 2 and having purpose-linked insurance cover, at these scheduled check-ins, what we're able to do is go back to principle 2 and overlay that with the updated figures of our current situation. Now, using those 4 key criteria that I shared with you to give you your purpose-linked cover earlier, you'll see how the numbers in a lot of these scenarios will lead you to needing less insurance than potentially before. What this means is that you can adjust the insurance cover levels that you need, which will ultimately reduce the amount of insurance premiums that you're paying on an ongoing basis. Now, if you're paying for those premiums from your superannuation balance, what this is going to mean is that you're going to have more money in your superannuation for retirement. This would be using the money for good. If you're paying for these insurance premiums from your bank account, there's a better way that you could look to spend this money rather than overpaying on insurance that you potentially don't need. As a bonus tip, if you are paying for those premiums from the bank account, you could use these extra surplus funds to put back into your mortgage again, further reducing the amount of need that you have for insurance and therefore expediting the process even further. Now, I understand that on the surface, interest rate cuts and insurance premiums don't seem to have a very close correlation. In this video, I hope I've shared with you a few key principles though that will help you use these interest rate cuts for good, not only to save you a little bit of money on your mortgage, but also help you out to save some money on your overall insurance package as well.